Capital structure ratios. 1. Debt-equity ratio. The ratio of borrowed funds and owner's vertical line capital is known as debt-equity ratio. This ratio reflects the relative claims of creditors and shareholders against the assets of the firm. Debt-equity ratio is calculated as follows. 2. Debt-asset ratio. The measures the share of total assets financed by outside funds. Shareholder less equity. Debt-equity ratio. Long-term debt. Total assets. Debt-asset ratio. Total debt. Financial and Management Accounting Unit 8. Sikkim Manipal University page number 200. 3. Proprietary ratio. The indicates the proportion of total assets financed by the owners. Higher ratio, say more than 75%, shows lesser dependence on external sources. Lower ratio, say less than 60%, shows more dependence on external sources. 4. Capital gearing ratio. The shows a mix of finance employed in the firm. 5. Coverage ratios. These ratios measure the firm vertical line's ability to pay certain fixed charges. The obligations of the creditors are met out of the earnings or operating profits. These claims consist of the following. 1. Interest on loans. 2. Preference dividend. 3. Amortization of principal or repayment of the installment of loans or redemption of preference capital on maturity. Table 8.1 depicts the important coverage ratios. Let us now discuss the coverage ratios in detail. 6. Interest coverage. The measures the firm vertical line's ability to make interest payments on long-term debts. Total assets. Proprietary ratio. Proprietor's fund. Total equity. Capital gearing ratio. Fixed income bearing securities. Interest coverage ratio, EBIT. Financial and Management Accounting Unit 8. Sikkim Manipal University page number 201. 7. Dividend coverage. The measures the ability of a firm to pay dividend on preference shares. Illustration 6. The balance sheet of Dravid Limited is as follows. Calculate the debt ratio and debt equity ratio. Solution. 1. Debt ratio equals total liabilities to outsiders / total assets equals debentures plus trade creditors / fixed plus current assets equals to 0,000 plus 1,000,000 / 10,000,000 plus 5,000,000 equals 3,000,000 / 15,000,000 equals 1. 5. Interpretation. The ratio indicates that the firm has Rs.5 assets for every rupee of long-term liability. Hence the financial position is good. 2. Debt-equity ratio equals outsiders' vertical line funds / shareholders' vertical line equity or equals debentures plus trade creditors. BSH capital plus pref SH cap plus reserves equals to 0,000 plus 1,000,000 8,000,000 plus 3,000,000 plus 1,000,000 equals 3,000,000 / 12,000,000 equals 1. 4. Assets. Fixed assets 10,000,000. Current assets 5,000,000. Represented by liabilities. Trade creditors 1,000,000. Reserves and surplus 1,000,000. 10% debentures to 0,000. 6% preference share capital 3,000,000. Equity share capital 8,000,000. Preference dividend. Dividend coverage. Net profit after tax. Financial and Management Accounting Unit 8. Sikkim Manipal University page number 202. Interpretation. The ratio indicates that the firm has Rs. For equity for every rupee of long-term liability. Hence the financial position is good. So far we have studied leverage ratios and the types of leverage ratios. Let us now discuss profitability ratio. Profitability ratio. Profitability ratios are designed to provide answers to the following questions. Is the profit earned by the firm adequate? What rate of return does it represent? What is the rate of profit for various divisions and segments of the firm? H. What was the amount paid in dividends? H. What is the rate of return to equity holders? The following are the important profitability ratios. 1. Gross profit margin. VIT is the ratio of gross profit to sales. 2. Operating profit ratio. VIT is the ratio of operating profit to sales. 3. Net profit margin. VIT is the ratio of net profit to sales. 4. Operating cost ratio. VIT is the ratio of operating cost to net sales. It is computed by dividing expenses by sales. Net sales. Gross profit margin. Gross profit 100. Net sales. Operating profit ratio. EBIT. Net sales. Net profit ratio. E. Net sales. Operating ratio. Cost of goods sold. Y. Operating expenses. E100. Financial and Management Accounting Unit 8. Sikkim Manipal University page number 203. Cost of goods sold equals opening stock plus purchase v closing stock. Operating expenses equals administrative expenses plus financial expenses plus selling expenses. The expenses ratio should be compared over a period of time with the industry average. For manufacturing concern, an operating ratio between 75% and 80% is expected. 5. Expenses ratios. These ratios indicate the ratio of various operating expenses to sales. Operating expenses include cost of goods sold, administrative expenses, selling, distribution expense, and financial expenses but excludes taxes, dividends, and extraordinary losses. 6. Return on capital employed. ROCE. VIT indicates the return earned on the capital employed in the firm. 100. Capital employed. EBIT. ROCE. EBIT equals earnings before interest and tax. Capital employed equals own funds equity plus borrowed funds debt. 7. Return on shareholders. Vertical line equity. VIT measures the return on the total equity funds of ordinary shareholders. Illustration 7. Frank Gottas Limited provides the following information. Cash sales Rs.80000. Credit sales Rs.100000. COGS Rs.158000. Return inwards Rs.2000. Calculate gross profit ratio and ratio of COGS. Shareholders' equity or net worth. ROEF. Net profit after tax. Preference dividends. E100. Net sales. Expense ratio. Concerned expense. E100. Financial and Management Accounting Unit 8. Sikkim Manipal University page number 204. Solution. Gross sales equals cash sales plus credit sales equals 80000 plus 100000 equals 180000. Net sales equals gross sales v return inwards equals 180000 v 20,000 equals 178000. Gross profit equals net sales v COGS equals 178000 v 158000 equals to 00000. 1. Gross profit ratio equals gross profit slash net sales x 100 equals to 00000 slash 178000 x 100 equals 11.2%. 2. Ratio of COGS equals 100 VGP ratio equals 100 negative 11.2 equals 88.8%. So far we have studied profitability ratios and the types of profitability ratios. Let us now discuss activity ratios. Activity ratios or efficiency ratios or turnover ratios. They are concerned with measuring the efficiency in asset management. The efficiency with which the assets are used would be reflected in the speed and rapidity with which assets are converted into sales. The important turnover ratios are as follows. 1. Stock turnover ratio. This ratio examines how quickly inventory is converted into cash. It indicates the number of times the inventory is replenished in a year. Inventory holding period. VIT indicates the time interval between replenishment of inventory. Average inventory. Inventory turnover ratio. Cost of goods sold. Inventory turnover ration. Inventory holding period. 12 months. Financial and Management Accounting Unit 8. Sikkim Manipal University page number 205. 2. Debtor vertical line S turnover ratio V indicates the average number of times the debtors make payment in a year. Debt collection period. It indicates the time interval between payments by debtors. 3. Creditors turnover ratio V is the ratio between net credit purchase and the average amount of creditors outstanding during the year. 4. Assets turnover ratio V indicates the efficiency with which firms use all their assets to generate sales. It is based on the relationship between cost of goods sold and assets of a firm. Average debtors. Debtors turnover ratio, net credit sales. Debtors turnover ratio. Debt collection period, months/weeks/days in a year. Average creditors. Creditors turnover ratio, net credit purchase. Creditors turnover ratio. Creditors payment period, 12 months. Average total assets. Total assets turnover, cost of goods sold. Average fixed assets. Fixed assets turnover, cost of goods sold. Financial and Management Accounting Unit 8. Sikkim Manipal University page number 206. 5. Capital turnover ratio V indicates the efficiency with which firms uses its capital to generate sales. It is based on the relationship between cost of goods sold and the capital of a firm. Lower ratio shows the lower ability to generate sales. Illustration 8. Birla Cements Limited provides the following. Stock. Opening Rs.75000. Closing Rs.10000. Credit sales Rs.00000. Cash sales Rs.50000. And gross profit 25%. Calculate the inventory turnover ratio. Solution. Net sales equals cash sales plus credit sales equals to 00000 plus 50,000 equals to 50,000. Gross profit equals 25% of 250,000. Net sales equals 62,500. COGS equals net sales v gross profit equals to 50,000 v 62,500 equals 187,500. Average inventory equals opening plus closing stock /2 equals 75,000 plus 100,000 equals 87,500. Inventory turnover ratio equals cost/average inventory equals 187,500/87,500 equals 2.14 times. Average capital employed. Capital turnover ratio, cost of goods sold. Financial and Management Accounting Unit 8. Sikkim Manipal University page number 207. Activity 1. Total sales of a firm is Rs.500,000 of which the credit sales are Rs.365,000. Sundry debtors and bills receivable are Rs.50,000 and Rs.000 respectively. Calculate the debtor's velocity. Activity 2. Total purchases is Rs.100,000. Cash purchases Rs.20,000. Discount. Provision on creditors is Rs.100,000. Purchase returns is Rs.000. Creditors at close is Rs.30,000. Bills payable at close is Rs.25,000. Calculate creditors' velocity. Activity 1. Solution. Debtor vertical line S turnover ratio equals net credit sales/debtors plus bills receivables equals 365,000/50,000 plus 2,000 equals 7.02. Debtors vertical line velocity equals number of days in a year/debtor vertical line S turnover ratio DRS. Collection period equals 365 over 7.02 equals 52 days. Note. Number of days in a year is taken as 365 days. Activity 2. Solution. Credit purchases equals total purchase v cash purchase v purchase return equals 100,000 v 20,000 v 2,000 equals Rs.78000. Creditors vertical line turnover ratio equals net credit purchases/creditors plus bills payable equals 78,000/30,000 plus 25,000 equals 1.42. Creditors vertical line velocity equals number of days in a year/creditor vertical line S turnover ratio Creditor vertical line S payment period equals 365/1.42 equals 257 days. Note: the reserve or discount on creditors should not be considered for calculating the net credit sales. Financial and Management Accounting Unit 8. Sikkim Manipal University, page number 208. Illustration 9. Total sales of a firm is Rs.500000, of which the credit sales are Rs.365000. Sundry debtors and bills receivable are Rs.50000 and Rs.000 respectively. Calculate the debtor's vertical line velocity. Solution: debtor vertical line S turnover ratio equals net credit sales slash debtors plus bills receivables equals 365,000 slash 50,000 plus 2,000 equals 7.02. Debtor's vertical line velocity equals number of days in a year slash debtor vertical line S turnover ratio. Debtor vertical line S collection period equals 365 over 7.02 equals 52 days. Note: number of days in a year is taken as 365 days. Illustration 10. Calculate creditor's vertical line velocity from the data given below. Total purchases Rs.100000. Cash purchases Rs.20,000. Discount provision on creditors Rs.1000. Purchase returns Rs.000. Creditors at close Rs.30,000. Bills payable at close Rs.25,000. Solution: credit purchases equals total purchase v cash purchase v purchase return equals 100,000 v 20,000 v 2,000 equals Rs.78000. Creditor vertical line S turnover ratio equals net credit purchases. Creditors plus bills payable equals 78,000 slash 30,000 plus 25,000 equals 1.42. Creditors vertical line velocity equals number of days in a year. Creditor vertical line S turnover ratio. Creditor vertical line S payment period equals 365/1.42 equals 257 days. Note: the reserve or discount on creditors should not be considered for calculating the net credit sales.